You can hear us, right?
Yes, yep, I can hear you, as can everyone else. Uh,
Good.
Hello, everyone, and welcome to our first virtual business workshop of 2025. My name is Kathy Sinor. I'm the Director of Administration Programs and Grants for the Niagara County Department of Economic Development. I'm excited to be your moderator today for our program on navigating tariffs and duty mitigation strategies. Before we begin the presentation, I just wanted to go over a few housekeeping items for you. First of all, you won't have to go crazy taking notes. Later on today, I will send out the slide deck in an email to you, which will also include the contact information for our presenters today. This workshop is being recorded, and we'll be putting it up on our website later this week if you wanted to rewatch it or share it with a colleague, and I'll be sure to send along that link to you as well. And finally, as an attendee, you will be muted throughout today's presentation. I encourage you to use the Q&A panel, the chat panel, or just raise your hand if you have a question. But putting that information in the Q&A panel because you won't be able to hear you, but we want to make sure that we're answering your questions along throughout the webinar. And if because of time, we're not able to get to all of the questions, rest assured that we will follow up with you after to get the information that you need. At this time, I'd like to introduce our presenters for today. First is Jim Trubitz. He's the Vice President of Business Development for Mohawk Global. Jim has over 40 years of knowledge in free trade agreements, customs compliance, logistics, and supply chain management. His experience encompasses courier, sea, air, and northern border operations. Also presenting today is Bill Fisher. He's a consultant for Mohawk Global. Bill has over 36 years of experience in international logistics and trade compliance. He has been a licensed customs broker since 1993 and a board member of the National Association of Foreign Trade Zones for over a decade. Gentlemen, the floor is yours.
Thanks, Kathy. Bill, why don't you introduce yourself too, and we'll start it off then. How's that? Good?
Sure. I mean, we've already done the bio, but I'm from Tennessee. I have spent the majority of my career in on the FTZ side of the house, more so than the bonded warehouses, but I have set up and managed bonded warehouses as well. I think there's a lot of good information today that people need to know about.
Exactly. I agree. So Kathy, next slide. So today we're going to focus on some really important things to help you keep that duty impact, from getting enlarged. You want to really be working on this. So we're going to look at free trade agreements. We're going to talk about one of probably the more important things that we're seeing out there, and that's tariff engineering. And we're seeing a lot of companies looking at this in the trade, and we're going to give you a couple best practices. And then Bill and I are going to look at bonded warehouses with you, and Bill's going to do a really deep dive on foreign trade zones as well. Next slide, please. So free trade agreements are so important for a company to utilize. And you have to understand that the U.S. has 14 free trade agreements with 21 countries. We may have a lot more in the next 90 days or less, where you're going to see different free trade agreements coming up. So, stay tuned on that. That could be a whole new topic for everybody. But obviously, for you as an importer, it's going to allow you to bring your goods in duty free and avoid paying the merchandise processing fee. That may not exclude you from some of the new tariffs that are imposed under the White House presently right now. So those could be driven by different scenarios as well. But this is going to allow you a lot more leeway. For example, if your goods qualify under the USMCA on goods that are originating in Mexico or Canada, they're outside the IEPA tariff and possibly the reciprocal. But like I said, that depends if your goods are subject to automotive or to the metal tariffs, that'd be something to keep in mind. Okay, so now you have to make sure that you meet these conditions. Obviously, um, Bill, I did this one seminar and I asked all these people in the audience, I said, how many of you goods, or how many are taking advantage of the USMCA? And everybody rose their hand. And then I said, how many of you know your tariff number? And only about half the people. And what it really comes down to is being able to classify your goods so you can look up that particular real rule of origin for the goods. Okay, that's a real important thing. And the second thing right now is, you know, these free trade agreements have transshipment rules in them. So you have to pay very particular attention to those. And I'll give you an example. I had a company that bought something from Ford up in Canada, brought it into the US, and then sent it under the free trade agreement um, to a Latin American country. It was in Central America. Turns out the goods had to be returned to the US. So these goods were returned to Miami and they wound up paying duty on them because the free trade agreement only allowed the goods to be imported from either Canada or Mexico. So this is something that's very important that you're paying attention to. And of course, obviously, if you're going to complete a free trade declaration, it needs to be properly completed. And last but not least, if you're the importer, you must possess information to support that declaration at time of claim. Next slide, Kathy. Okay, so um, whenever you take advantage of a free trade agreement, it's up to customs in Canada, US, or in Mexico. They have the right to validate to make sure you qualify for the free trade agreement. So this is something that you want to keep in mind. And back in November of 24, Customs sent out a message. They're called CSMS messages, and Bill and I peruse these every single day for changes. And so we look at these things, but what it really came down to is they want you to have someone who's completing these documents be a responsible official that has knowledge, and you know, you're going to have to be able to provide documentation when it comes up. This is very, very important. Okay, Kathy, next slide, if you don't mind. Okay, so obviously, whenever you're claiming something that's conditionally free, there's risks. Okay, you know, um, and I'm going through this right now with a company right now. They do construction equipment, and they sent me a scenario, and they didn't really give me enough detail to determine if they're going to be valid under that free trade claim. So I'm going to have to go back to them and ask them for more details, um, such as a bill material. But customs doesn't want you just taking the, your your USMCA declaration from one year to the next and changing the date on it. They actually believe that you have a folder with supporting documentation. So this is something that, sure, you can take advantage of that free trade agreement, but you got to make sure you're documenting, documenting, documenting. Okay. And then, every once in a while we'll go through this. You can go back one more second, Kath. Um, Sometimes supply chains change. Let's say that for some reason the one part you need to make that article, you have to change countries of origin on it. Maybe you were buying it from Canada or Mexico and it was incorporated, but now you're buying it from another country and it's not part of that free trade claim. You may disqualify your claim for the free trade agreement. So this is something that if you're not sure, call an expert and talk to them. This is why you don't have to go it alone. I think that's really important that when you're to exercise reasonable care and make sure you're talking with a broker beforehand if you're going to make changes. And then you're going to want to make sure you communicate with your broker because free trade certificates are only valid for 1 year at a time. So, and we've seen this happen where someone will keep claiming it, thinking that you still have your free trade certificate in place. And if you don't, customs could make you go back and pay back those duties. Um, and then last but not least, you'll say, okay, fine, help me out. Is there a good side-by-side comparison on the various free trade agreements that I could refer to? In this presentation, there's a great hyperlink and it gives you a really nice side-by-side of the different free trade agreements. Bill, anything you'd like to add here?
Um, no, not in any great detail, but I would like to echo your comment about companies just signing the new agreement each year. I've actually heard, and this has been a number of years ago, but one of my last stints in brokerage, I heard a colleague ask another colleague about a shipment from Australia, and their comment was, "Oh, well, it came from Australia, so therefore it qualifies for the Australia Free Trade Agreement." Just because it happened to come from Australia. And that clearly is not the case.
Mhm.
There's more to it. So,
Yep, perfect, perfect. So Kathy, next slide, please. So when it comes to your compliance program, your tariff classification is the most important thing that needs to be done. And it has to be done to help you determine free trade agreements. Are you subject to other government agencies? Is there other requirements that need to be met? Is there any special marking requirements? So your tariff classification is probably the most important thing you need to do for your compliance program. And I'm going to let Bill talk here. Okay.
yeah, I think this is doubly true if you're going to move forward with a bonded warehouse setup or an FTZ designation, whether it's manufacturing or distribution. I've seen a number of companies that in the past that looked for the most favorable duty rate they could as opposed to the proper tariff number. Um, and when you get into the gray area, yes, there can be some determination depending on the GRIs of how where that item should be classified. But if you don't go back and review your tariff numbers today, you may unnecessarily be falling subject to a Chapter 99 number that increases the duty rate, or you might be avoiding a number that come time for an audit, you might find out that you've now have to make a disclosure. And this is very true when you get into the FTZ, especially a manufacturing FTZ, because many companies find out that their items not being classified correctly. Now all of a sudden it's affecting their zone status if they choose, and that then has a domino effect of running into other issues. So having your items properly classified is tremendously important.
I would have to say, Bill, too, that in as of late, customs seems to be a lot more enforcement minded. Okay. So there you might say, look at I've been classifying this one article under this tariff number for as long as I can remember. And it never seemed to be an issue or matter. Now it seems to be customs is questioning a lot more classifications. And you need to be able to defend your reasoning on how you came up with that tariff classification. And and you have great resources to do it, and that's something that people should keep in mind. And it might even come down to seeking a binding ruling to get one, just so you have that clarity. But, we can leave it at that. Um, yep.
Well, one thing to add to that, Jim, at the National Association of Foreign Trade Zones conference in Savannah last month, um, there was a conversation that was held with Customs headquarters previously, not at the meeting, but had a meeting that had happened before the conference. And the comment was made that Customs headquarters said that they had now just moved purely to enforcement, and were I'll say, I guess, unofficially moving away from facilitation, but focusing on enforcement.
hmm I agree with that comment. We're seeing a significant increase in requests for information from customs and notices of action and rejects of entries for further questioning. So I think that this is going to be the new normal for a while. Next slide, Kathy. So um, here's some great examples here. We got Nike where if you ever look at the bottom of your Converse, you'll see felt on the bottom of it, and that allowed the duty rate to go down. Um, Converse also has had other ones that were maybe not as positive and were negative, and I know that we can talk a little bit about that, but you know, we always joke that Customs is probably the number one designer of products for classification purposes. So a lot of times people will re-engineer their product to do certain things. I had one client recently that added aluminum components to their thing to qualify it under the 232s so they could pay less duty than if they had brought it in under the Chinese tariff, which at the time was 125. So people are doing a lot of tariff engineering. So, and obviously you can see the same thing with that Columbia Sportswear where they put the pocket on the blouse. Um, but go ahead, Bill. I want you to delve into this too. I know
Uh,
you have.
yeah, I mean, it's just, I don't know if I would say the term is creative or strategic, but I do think that companies are trying to uh, they're utilizing their compliance people more, or need to be using them even more to help in opportunities like this, or situations like this where there might be a more advantageous way to import the product at a lower duty rate, but again, assuming that the products are properly classified as opposed to just randomly looking for something that's a lower duty rate.
I have one more example here, and then we'll get moving on to the next slide. I had a client that they were classifying their article under one tariff number forever. And when I met with them, we looked in customs rulings search engine. And Bill, this was amazing. They put in their competitor's name for the same product, and customs had given a ruling to them probably 12 years beforehand using a different number, which took it out of the the metal tariffs, the 232s at the time. And they were like, gee, I wish we had known. We've been misclassifying this thing for 12 years. So people need to do their due diligence on this now.
Right.
Okay, so obviously, you know, people have to be careful too. Like you said this earlier, strategic um, or creative. Sometimes getting creative might not work. It was funny because when I saw the first one for Converse, I thought of the second one. My wife has a pair of Converse sneakers that have sequins on it, and customs ruled that they weren't sportswear, they were considered dress wear. And they went from the 12% up to the 37 again. So sometimes when someone makes a product, you think, oh, we can use the same tariff number we used before, but you have to be careful. And as you can see here, look at Florida shoe used that felt, but it was removable. So that this is where you have to be careful. And Ford went through this with those cargo vans where they got them to the port and they were what, removing the back seats out of them, and they were actually cargo vans then, and to avoid that 25%. You know what I mean? What would you like to add here, Bill?
I was just going to use a similar example, and this may not still be true today because I haven't dealt with computer printers in a while. But years ago, um, printers would come in at 3.7% as a completed printer. But if you simply took the toner cartridge out of the printer, um, the engine became incomplete, so therefore it fell under a tariff number that was duty free. The toner cartridge fell under a duty free number, and then you simply put those two together after import, and you've got a completed printer. And it was a way that a company reduced their landed cost by 3.7% by simply just being smart about how they import the product. So,
Mhm. Kathy, next slide, please.
Bill and Jim, I don't know if you see, we do have a question. When you mentioned that we need document, what type of documentation is required?
I got this one for part of it. So are we talking about the free trade or the tariff classification? If we're talking free trade, I can send you the USMCA instructions, and they list some of the items that would be used for documentation. If it's tariff classification, I'm gonna let Bill comment on this. Okay.
well, that is a very uh, that's a simple question with a very difficult answer. It's not that it's difficult in what documentation is needed, but depending on the item, could potentially dictate a different amount or different types of documentation. I mean, it could be everything from engineering drawings to sales contracts to obviously bills of material. If you're looking at products that may have multiple items in it, end use certificates of what the particular item may be. Um, like a steering wheel coming in for an automobile doesn't have its own tariff number, but if it's going to an automobile or a pickup truck, it would fall under two different numbers depending on which vehicle it's going to be attached to. So the documentation can get quite voluminous.
The the one thing too I'd like to add is if you're relying on a tariff classification decision in cross, or you're going to seek a binding ruling, you're going to want to reference those in your research, because Bill and I know that you could, if customs ask about this tariff classification 6 months or years later, they're going to want to know, how did you exercise that reasonable care? And looking back and say, well, we had it classified under this, but we determined it was that, and this is the ruling we used in cross to support our claim. And before we notice this change, or sometimes we'll see court cases that change things. It's very important that you use your logic and can demonstrate to customs that you did use reasonable care and you just didn't pick the lowest duty rate.
Yeah, I think depending on where your item falls under the general rules of interpretation, probably the further down the list you go, the more documentation you would need, because that's obviously the less specific it is. So then it becomes more interpretation, if you will.
Mhm. Thanks.
All right, so bonded warehouses and foreign trade zones. This is at least on my side of the house today, in the work that I'm doing, these two items are of great importance to people right now, because it's in addition to what duties can I save, it's what can I do to postpone those duties, or can I do anything to postpone those duties? So the next few slides are going to be on the similarities and differences of the bonded warehouse and foreign trade zone program. Um, we could we could talk for hours on both of these two programs and not cover it all, but we're trying to hit enough information to give you a good baseline of would either of these programs potentially benefit you, and if so, then you can do some more research to or contact an expert to talk about what that benefit would be and how would you go about achieving that or implementing it. So first, what is a bonded warehouse? A bonded warehouse is a building or part of a building or secure or area that is secured by customs, but it is deemed to be inside the customs territory. So we know geographically it's inside the United States, but the commerce of the United States is what's significant here. So what that means is the merchandise can be brought in and put into the facility where duties and taxes are not paid at the time of import and receipt into the bonded warehouse. But they must be fully compliant with all the laws and regulations of the United States. And also the duties, while they can be postponed, there is a limit to the time period that merchandise can be stored in a bonded warehouse, which is 5 years from the original date of importation. So if a shipment came in on January 1st, 2025, but you did not receive it because it sat in somebody else's bonded warehouse or it sat in the port for a few days. I mean, 15 days would be the max for that before it was sent to general order. But if it sat in a bonded facility for a year and then it was transferred to your facility, a year of that 5-year clock has already expired. So it goes back to the original date of import, not of the date that you receive it.
Mm-hmm.
So bonded warehouses typically are used for storage, distribution, manipulation. Some manufacturing can be done in a bonded warehouse, but only in a Class 6 bonded warehouse, which is specific for manufacturing. But with the bonded warehouse, it's all a customs process, customs program. So customs is the judge and jury, if you will, as to approval, what can be done, what parts of the regulations are applicable, and then making sure that you comply with those regulations. So that, in a nutshell, is a bonded warehouse. So let's go to the next slide, please. So some of the benefits of the bonded warehouse, you can defer the duties, which means you pay them at the time the merchandise is removed from the bonded warehouse for U.S. consumption. So it's a cash flow savings. You can avoid the duties on merchandise going into the bonded warehouse if it's going to be re-exported or destroyed. And then in some cases with internal revenue taxes, you can defer or avoid those taxes if the merchandise stays in the bonded warehouse and then is removed for export. If it's removed for consumption, however, then the taxes are payable at the time of removal. So it's just a postponement in that or deferral in that instance. Excuse me. So some of the limitations of the bonded warehouse, you cannot receive and store domestic merchandise in a bonded warehouse space or imported merchandise on which all duties and taxes have been paid. So that's why I said a minute ago that it typically is more a part of a building as opposed to the entire facility, because companies obviously have both foreign and domestic, and then also duty paid and non-duty paid merchandise, and you have to physically segregate those in a bonded warehouse. I mentioned a minute ago that all merchandise, if it's subject to a PGA, must be fully compliant. So you cannot take merchandise, say, pharmaceutical product that has not received FDA approval and put it in a bonded warehouse because it has not complied with those laws and regulations, because it's inside the commerce, excuse me. So that becomes a very critical point. I mentioned the 5-year time limit on the storage. It requires all documentation for entry. So if you receive a shipment, it's imported, and the documentation is lost or misplaced or incomplete, the merchandise cannot have a warehouse entry filed on it, because you must have every bit of documentation and information needed for entry at the time of warehouse deposit. It does require either self-filing, so you can file your own entries for a warehouse, just like you can as an importer, Or if not, then it's a customs broker can file those warehouse entries and withdrawals for you under a power of attorney, because any transaction going on with the bonded warehouse is deemed to be doing customs business, which you can perform for yourself, or a broker can do it for you. And the operational challenges, in my opinion, and this is just my opinion, it's not maybe not some other people's opinions, but the bonded warehouse can present, and in my opinion, does present some operational challenges, in the sense that if you have items A, B, and C in inventory, and you import item A, and some of it's customs cleared, some of it's not. Now you have to physically segregate that merchandise and inventory. If you receive 2 shipments of item A into the bonded warehouse, they have to be physically segregated, unless you've been approved for FIFO storage. But then there are some very severe, not severe, but there's some very detailed restrictions and requirements of FIFO inventory in a bonded warehouse. So that's a couple of them. I mean, there's a number more that when we get a little further in the presentation, there's 2 slides that are very detailed that compare the programs in a lot more detail. So we can maybe wait for those. So next slide. So we mentioned the bonded warehouse. So at a high level, what is a foreign trade zone? So a foreign trade zone also is a defined area that is secured, but it is deemed to be outside the commerce of the United States. And this is the biggest difference, or one of the biggest differences. So merchandise that is stored in a foreign trade zone, it's treated from a duty standpoint and from a regulatory standpoint. That merchandise is the same as if it's on a ship at sea, or it's still sitting in a warehouse in Japan or China or Canada. It's the U.S. laws and regulations do not apply to that beyond securing that merchandise in the facility. So the most common uses of the foreign trade zone are for storage and distribution, for manufacturing, consolidating freight for export, which you can consolidate not only multiple import shipments into single shipments going out, but you also can add or consolidate it with domestic shipments, imported merchandise on which duties and taxes have been paid. So you can have all that merchandise in the same FTZ, and you don't have to segregate it like you do with the bonded warehouse. And then the last bullet point there, frankly, I'll take a little issue with the way that's worded, so I apologize. That's attempt to avoid quotas. I don't believe you can avoid a quota, but you might be able to postpone that. Well, you can postpone that merchandise or hold that merchandise till a quota is reopened. And there may be some allowances through manufacturing that might get you around a quota. But the word avoid in there, I think, is a bit possibly misleading. So I apologize about that.
Bill, I was going to say one thing. Someone described to me once that foreign trade zones are the nimble cousins of bonded warehouses. That was kind of the summary.
I would agree. I've said during my career that there is nothing you can do in a bonded warehouse that you cannot do in a foreign trade zone, but there are many things you can do in a foreign trade zone that you cannot do in a bonded warehouse. So maybe said a little simpler, a foreign trade zone is a bit of a bonded warehouse on steroids, if you will. So next slide. So I already talked about some of these. With duty avoidance, so merchandise can be brought into a foreign trade zone, and if it's going to be exported, destroyed, let's say that while it's in storage, it has a shelf life and it expires while it's on the shelf, you can dispose of that merchandise under customs procedures and avoid the duties and taxes paid on that. Duties are postponed or deferred, like they are in the bonded warehouse. Duties can be reduced in the event of damage. In the event of expiration, there can possibly be some benefit there with the undervaluation law. That particular point is a limitation right now, which you see on the right side. The current punitive tariffs have eliminated most, if not all, of the current manufacturing benefits, the duty reduction benefits through manufacture. The reason being that with the law state that for imported merchandise subject to these punitive tariffs, 232, 301, other IEPA, reciprocal tariffs, what have you, that merchandise must be admitted into the foreign trade zone in what's called privileged foreign status. So that locks the duty rate in at the time of receipt, time of admission, at the component level and at the duties and tax rate subject to that particular component. Even if it's changed through manufacture, when it's removed, it still must be declared as if it were the component. So right now, that is a big limitation with the foreign trade zone program. And frankly, I've got more clients looking at a bonded warehouse right now because of this particular issue than I do foreign trade zone. But the challenge that they're now faced with is they did not know, or some of them did not know, of the operational challenges of having to segregate the inventory and having to potentially put a fence inside their building to separate the space. So there are the operational challenges are causing some of these clients to rethink their potential decision. Not all, but some.
Bill,
Yes,
NAFTZ, the association, are they fighting that last point there?
they are. They're soliciting comments from all the members. They have submitted comments themselves on behalf of the members at the NAFTZ conference in Savannah last month. This was a very big topic of discussion. Unfortunately, the answer was we don't know yet what the difference will be or what changes will occur. But I think the overwhelming sense was that everybody believes something's going to occur, but what that something would be, if you ask 5 different experts on it, you'll probably get 5 different answers right now. But the fact that the Trump administration wants to bring manufacturing back to the U.S., and this currently is a inhibitor to that, at least related to the companies that are foreign trade zones, we believe that something will occur that will either change that, eliminate that, or could potentially make it even better to where companies not in foreign trade zones still pay the punitive tariffs, but potentially companies that are in foreign trade zones might be able to avoid this. We don't know yet. I mean, that's pure speculation, but if that were to occur, then I could see an overwhelming number of companies looking to get into the foreign trade zone program. And I don't know that there would be enough experts out there to handle all that volume or all that interest. Stay tuned, I guess, would be the message there. We don't know how that's going to go yet, but we think it's going to change somehow, somewhat. I mentioned the internal revenue tax already that can be deferred or avoided in the bonded warehouse as well as the foreign trade zone. And then there are other benefits which we cover on the next slide. So if we could advance that, please.
Sure. Just one moment. We do have a comment from Joanne. I think it's more of a comment for all of our attendees. The importance of having your purchase orders along with your documentation so you can have that historical trade data trail to prove that you're claimed for an FTA and support an audit.
That's a good point. So this slide's a little repetitive. About the only difference between this slide and what I've already spoken about is I mentioned the duty inversion. That would be the term that you hear some people use. That's through the manufacturing benefit if the restriction was not there of the zone status. And then the harbor maintenance fees are paid quarterly if you're utilizing the foreign trade zone as opposed to at the time of import. So there is a deferral on those harbor maintenance fee payments for a 90-day period, potentially 90-day period, depending on what point during the quarter that merchandise is imported. So that would be a nominal savings, but a savings nonetheless. So if we could go to the next slide. These are some other very specific benefits that the FTZ program has that the warehouse does not. There is a provision in the regs called the production equipment allowance, and what that means is if a company is it's most utilized in a new plant being built, but it also can be used on an expansion or a retooling a number of different ways. But essentially, what that means is if a company were building the plant today while it's a greenfield or a brownfield, they could apply to have the facility designated or the property designated as an FTZ. They activate the space, even though it's just a green or brown field. They then import all the shipments that they're importing to build the facility, whether we're talking about the superstructure or the tooling or the equipment that goes inside. And then once the plant is completed building, which if you look at an auto plant, that can take 3 or 4 years and could be literally thousands of import shipments. Um, the allowance provides a benefit where no, all the shipments come in bond, they're delivered to the site, everything is completed. You even can run pre-production testing, but once the plant's ready to go into full production, one customs entry is filed for the entire facility, all the thousands of shipments or hundreds of shipments or whatever the numbers turn out to be, for the time it took to build the plant or expand the plant or retool the plant. And that definitely would be a significant benefit in the terms of broker fees, MPF payments, duty deferral, and then potentially duty conversion or duty inversion from the components to the completed equipment that goes into the plant. So that can be a tremendous benefit. But you can't set up a zone just for that. It requires continued operation. So there are some provisions for that that need to be you need to be aware of. The second is weekly entry. That means that if a company specific or unique to the FTZ program, a company can file one weekly entry for all outbound shipments to the U.S. commerce from the FTZ. So if a company, say, imports today 1,000 shipments, and those shipments are all filed with customs, that would be 1,000 consumption entries, coupled with 1,000 broker entry fees and 1,000 MPF payments and 1,000 duty payments. With weekly entry, those 1,000 imports could now be reduced down to 52, and it would be the same amount of merchandise, but 52 consumption entries would then yield 52 MPF payments and 52 broker fee payments. So it can be a tremendous benefit. I'm aware of companies saving 6 figures just in broker fees by weekly entry. And I've seen companies save well over $1 million, depending on their import volumes and their value of merchandise, in MPF payments via weekly entry. So weekly entry is a tremendous benefit that is only available through the FTZ program. I've just touched on the broker fees, which ties to the weekly entry, so I won't reiterate that. Zone to zone transfers, if you have a customer that is also operating in a foreign trade zone, that merchandise can be shipped duty free from your foreign trade zone to the customer's foreign trade zone with no duty payment, if that's the way you would like to do that, or your customer would like to do that. So it's a way to extend the savings, if you will. Just a quick anecdote here. I had a customer years ago that was looking at setting up an FTZ purely for weekly entry and MPF benefits. They said they had $750,000 savings in MPF if they were to set the zone up, and asked me to come look at it. And in looking at it, I asked to do a full savings analysis, which they were a little hesitant at first. And I said, I just want to make sure that, I'm sure you're right, but everything, I like to look at everything, so just to make sure that we haven't missed anything. And it turned out that 65% of their outbound shipments, because they made automotive transmissions, were going to companies that build automobiles in a foreign trade zone. And when you looked at their duty payment, their savings on zone to zone transfers by shipping merchandise, their transmissions to the auto plants under a zone to zone transfer, was a $6.5 million savings a year on zone to zone transfers. So they were floored. In fact, it took another probably 3 months to convince their senior management that this was legal. They felt like it was illegal in order to be able to save that much money, but we finally got them convinced of it. But it can be a tremendous benefit depending on your situation.
I think, Bill, this kind of illustrates too that the importance of doing those feasibility studies too. You know, you have to examine to make sure it's worthwhile. There might be added benefits that they didn't even see.
Right. We are getting not short on time, but we're getting, I want to make sure we get through everything. So I'm going to speed up just a little bit. Waste and scrap is a benefit through the Foreign Trade Zones program, which if you have damaged merchandise or if you're manufacturing, the waste and scrap that falls to the floor or fails in quality testing or whatever can be avoided through the FTZ. I've already talked about the state level benefits. Again, for time's sake, I'll skip the last 2 points because those are more procedural type things, but they are benefits nonetheless. So if we can go to the next slide. So deferral applies to both the bonded warehouse and FTZ. Again, that's a cash flow savings of not paying the duty until at the time of import, until the merchandise is removed from the bonded warehouse or the foreign trade zone, and only removed for U.S. consumption. If it's removed for export, then those duties would be avoided. So we can go to the next slide. So here's an example, just a quick example, a very simple example of how duty deferral works. So you see the import shipment occurring on January 19th in this example. It moves to the facility, say it's an inland facility, and arrives on January 24th, and it's received into the facility. On April 18th, the goods are sold. So it's sat in inventory from January 25th to April 18th. Where at that point the merchandise is sold and ships out of the facility, and via weekly entry, the merchandise is filed. One entry is filed for the week of April 12th through the 18th, as you see in the box just below the little icon there of the truck. Excuse me. And that creates that deferral of that, where that exemplifies the deferral from the time of receipt on January 25th through the date of domestic consumption. If this weren't in a bonded warehouse, again, you would file an entry, so you would gain that same deferral, but the entry would stand on its own. Each withdrawal must be filed as a single entry, or is most commonly filed as a single entry against the warehouse deposit. So that deferral is available through both programs. You see below the right icon there that it states before the FTZ or the bonded warehouse, the duties would have been paid on February 2nd, which would have been the time period after import if you're on the ACH payment, the periodic monthly statement. But in this example, because of deferral, the duties are postponed until May 19th. Which is a 106-day deferral. And just a quick example of what that would be cash-wise, if that one shipment had a duty obligation of $150,000 and it sat in the facility for 106 days, just with a simple time value of money calculation, that would come out to a $2,600 cash flow savings on that one duty payment. So if you look at that over the full inventory for a year and you look at all those deferral opportunities, the numbers can add up very quickly. Next slide, please. Duty avoidance is available through both programs, the bonded warehouse and the FTZ. Essentially, the merchandise is brought in, and if it's re-exported or if it's destroyed or damaged or expires while it's on the shelf, so to speak, the duties and taxes can be avoided if it's destroyed or exported under customs procedures. This is true not only of the column 1 duty, but also the 232, 301, anti-dumping, any countervailing duties, the internal revenue taxes at the state level, and then also the IEPA, reciprocal tariffs, what have you. So I kind of walked through that earlier, but essentially the merchandise moves in bond to the FTZ or the bonded warehouse, and then as it's going to be removed for export or shipment to another bonded facility, it would move under another in bond, so the duties and taxes would be avoided at that point. Next slide, please. The internal revenue taxes can be deferred in both the bonded warehouse and the FTZ. Essentially, that's I mean, it can be on other things, but predominantly on wine, beer, spirits, tobacco. That can even be, there are companies say that have wine from the Napa Valley. So it's domestically produced wine. If you put that into a warehouse today and it sits there for a year, the internal revenue taxes are paid on that merchandise, even though it came from grapes out of the Sonoma Valley. But if you put that in a foreign trade zone or a bonded warehouse, those taxes are postponed. You see a lot of this, or not a lot maybe, but a lot in the grand scheme of things, where ports like Los Angeles and New Orleans and Jacksonville, where there's a big cruise ship volume, or international commercial flights, where the alcohol is put onto the planes and or cruise ships for what would be an export. So that's a way to avoid those taxes, and that can be a very good use of the programs. Next slide, please. This is really kind of repetitious again. It's just a graphic showing that if the merchandise is exported, then the excise taxes are avoided. So next slide, please. Waste and scrap. There's benefits through both the bonded warehouse and the foreign trade zone. And the difference, most of you probably know this, but waste, it's goods with no commercial value that can be disposed of with this says no compensation or no payment to U.S. Customs. Scrap would really be a byproduct of a manufacturing process or a packaging process, or something that renders that inventory unusable. If it's sold to a recycler, then the duties are based upon the recoverable value. So think of aluminum cans that go to a recycler. Instead of purchasing the cans, there is a payment of so many pennies per pound. So the duties would be based on that scrap value, as opposed to possibly the value that those cans might have been imported at. Next slide, please. So MPF savings, I mentioned a minute ago under weekly entry. This only is available through the FTZ program. Imported goods generally are subject to MPF at a standard 0.3464% of the entered value. And it obviously has a minimum currently, because this does change or can change, and usually does change on an annual basis for the government year, of $32.71 is the minimum amount paid, and $634.62 is the current maximum. When you look at 52 entries per year, the most MPF that you would pay would be $33,024, $33,000.24. That's the $634.62 times 52 entries. So if a company is paying more than that, and I just did a savings analysis for a company the other day that paid $1.3 million in MPF payments. So if they were to move into a foreign trade zone, they would immediately have a $1.2 million savings just in MPF by utilizing weekly entry. So this is something that is, again, only available through the FTZ program, but can be a tremendous, and usually is a big benefit to the companies operating in a zone. Next slide, please. So this is just another quick example. So without a foreign trade zone, you see there on the left, $330,000, $330,002 spent in MPF. That's 10 shipments per week, 520 a year. Cleared separately, that's 520 entries times the MPF payment. That's assuming that each shipment hits the max. And frankly, in the analysis I've done, most consumption entries, or not most, but a company's entries filed throughout a year rarely hit the maximum per entry. They hit the maximum frequently, but because of air shipments or LCL, LTL, courier shipments, obviously there are a number of entries filed that don't hit the maximum. But you get the point, I believe, here. And with the FTZ, obviously through weekly entry, again, that can be capped at a tremendous benefit. So that in this example, it's a $297,000 savings on those same 520 shipments. Next slide. Duty inversion. I'm going to skip this one for right now because of the current situation that we're all in with the merchandise going in and privileged foreign status. This is less of a benefit right now for the FTZ. Actually, it's almost no benefit for most FTZs right now. But in the event that is resolved, then there would be a potential of reducing the duty rates on the components for the items that where the finished good has a lower duty rate than the components that go into them. So next slide, please. This is an example of that inversion opportunity. So in this instance, you're importing tires, a windshield, and seat belts. Those have a higher duty rate than the finished automobile, which below that you see the automobile has a duty rate of 2.5%. Those three items above have a 4%, 3.5%, and 3% respectively duty rates. And then you have a seat that is duty free. So you would want to lock that in as privileged foreign so the duty rate does not go up from 0 to 2.5%. So you're able to pick and choose. This would be true when and if the current situation changes or goes back to the way it was before. But right now, this benefit would not be or potentially not be possible depending on your tariff numbers of your items. Next slide. Oh, there is a question from Paige that says if you pay a tariff and need to return that item, can you get that tariff money back? Let me expand on that question maybe just a little bit, that if the tariff is paid, so let's say the merchandise comes into the zone or the bonded warehouse, it's withdrawn for domestic consumption, the duties and taxes are paid, and then it's going to be returned. If it's going to go into it can't go into a bonded warehouse because it's domesticated at that point, so that's not possible. You could potentially export it or and then file for drawback, but it would not be eligible to go into a bonded warehouse. You could, however, admit that same merchandise, that item that's being returned, into a foreign trade zone. If you're not going to resell that merchandise, you could put it in zone restricted status, which is a status specific to merchandise that will either be destroyed or exported. And then by admitting that in zone restricted status, it would be deemed exported at that point. So then drawback could be filed to get a refund of that tariff. And then it would be up to the company as to whether they wanted to re-export that product or destroy it. So potentially they could destroy it and save the export freight, but also get the money back through drawback. So that's getting a little deep into the weeds, but that would be possible through the FTZ, but not the bonded warehouse.
I just wanted to say one thing to Bill. As you're aware, Section 232, IEPA, and anti-dumping and countervailing duties aren't eligible for duty drawback. So this is why these programs are more effective.
Right. Good point. This slide on harbor maintenance fees, I mentioned this a minute ago, that harbor maintenance fees are paid quarterly in the foreign trade zone. This only applies to the foreign trade zone because in a bonded warehouse, while the duties and taxes and MPF are deferred as the merchandise goes into the bonded warehouse, the harbor maintenance fees must be paid at the time of import. With the foreign trade zone, there is no option. The merchandise comes in, the HMF is calculated, but it is paid on a quarterly basis as opposed to the time of import. So there is a deferral of that for potentially 90 days. So next slide. And this would be the form that this is the customs form 349, which the harbor maintenance fees are paid. So they're summarized on this. It covers the quarter, and then the zone operator or the user pays the HMF once this is completed. So next slide. Weekly entry, I think I've spoken about that enough, not enough. There's a lot more to the program, but I've given enough examples, I think, to skip this slide. But this, again, is the one shipment or the one consumption entry per week that we've talked about. So this is a tremendous opportunity. A question that some companies ask is, I'm expecting to save more in weekly entry than what I actually did save. What are the causes of it? This gives some examples as to why those savings opportunities might not be the full amount that was expected. The regulations do require that you cannot exceed your weekly estimate. So if you tell customs you think you're going to ship $1 million and you're going to ship $1.1 million, you've got to file a second entry for that week to cover that overage amount. So that then would result in a second merchandise processing fee payment that week. And this just gives some examples of other opportunities that might cause additional broker fee payments, MPF payments, what have you. So again, since we're already 2 minutes over time, I think we can skip to the next slide. This is an example just to show, it's a very simple example, but these shipments coming in, you see the shipments coming over the West Coast there, you see the airplane shipments coming in, and they're all moving to a facility that's located in the center of the country, and then it's distributed out to its U.S. destinations from there. Kathy, if you hit the mouse one time, it'll show the numbers at the top of the example.
It's a PDF, so sorry.
Yeah.
Oh. Okay. So in this example, what I was hoping would show up is the fact that these 144 shipments that are shown on the shipments coming in, going to the facility in the middle of the country, with a average MPF payment of $250 and broker entry fees of $125. Potentially, these 144 shipments would cost the U.S. importer $23,000 in MPF payments, $13,000 in broker entry fees, and another $37,000, or a total of $37,000 for 1 week's worth of imports. These shipments coming in during that week. If those same shipments went to the FTZ and were consolidated through weekly entry, the MPF payments dropped down to one MPF payment of $634 instead of $23,000. The broker entry fees dropped from $13,000 to $7,500, looking at a standard $350 entry fee. So the entry fee goes up, but the number of entries goes down. And then when you total that up, instead of spending $37,000 total for MPF and broker entry fees, now the importer is only paying $7,200. And when you look at those numbers over a 52-week year, that's a $1.5 million savings just by moving the same shipments through an FTZ instead of traditional imports.
Mm-hmm.
So that was to exemplify. Kathy, if we could, before we email this out, if we could remove those, there's 2 boxes over those numbers, that would be, I think, beneficial to the people getting a copy of the presentation.
Okay, we can do that.
Next slide, please. So this is just a quick side-by-side comparison of the FTZ opportunities on the left, bonded warehouse on the right, and then in the middle there are the things that would be pertinent. And so it shows you by explanation here that for customs, the customs territory, a foreign trade zone is considered outside of the customs territory. Bonded warehouse is inside the customs territory. Zones are regulated by both the FTZ board and customs, where the bonded warehouse is only regulated by customs. So if you follow that logic down, it gives you a side-by-side comparison. 2 things of note down at the bottom. For time to establish from a timeline standpoint, typically I've told companies based on more than 25 zone setups that I've been involved in, a non-manufacturing facility takes about 4 to 6 months, and a production facility can take 7 to 9 months or more. However, today the FTZ software companies, because they are being inundated with requests to set up zones or provide software for zones, they are now the bottleneck. Not to beat them up, but they are quoting a 4 to 6 month timeline just to get the software ready. So that timeline will be extended. So just so you're aware that that would be impacted by availability of programmers in order to implement those softwares. Also, if you look on the right side, customs is now the bottleneck on setting up a bonded warehouse, where in the past they've said 1 to 3 months to set up a bonded warehouse start to finish. We now have some ports saying it's going to be 3 to 4 months before they can even come out and do the initial survey of the facility to see what security they would require. So setting up either a foreign trade zone or a bonded warehouse right now is a longer process than it has been, just because there's more people in line, if you will. So if a foreign trade zone or bonded warehouse is something that you're thinking about, just know that time is of the essence. So the quicker you make the decision, the quicker the project gets kicked off, obviously the quicker it would be implemented. So next slide. This, I'm not going to go through this one, but this is all the benefits that I talked about in the prior slides in a side-by-side comparison. So again, you can read those or look at those at your leisure. So next slide. And I think it will be the last slide. Yes. Any questions that have not been asked yet?
We'll give everybody a minute if they want to post a question now. People are typing in questions. I just wanted to make a note that Niagara County does have a foreign trade zone. We have foreign trade zone number 34. It is located around the Niagara Falls Airport. You can learn more about it by going to our website, which is niagaracountybusiness.com. And then we have it listed under the incentives tab. So if people have questions about that, there's a link on that website. You can contact us or contact the person who runs that foreign trade zone. To give it another few seconds if anybody has a question. All right, gentlemen. Well, I want to put up your contact information there. I want to thank you both for taking the time today in your busy schedule to inform us about all these duty mitigation strategies, foreign trade zones, bonded warehouses. I know I learned a lot, and I'm sure all of our attendees did as well. As an attendee, when you do leave the workshop today, there will be a survey that pops up in a new window. We would appreciate any feedback that you can give us. You have an opportunity there to leave your contact information if you'd like us to contact you directly. And that's all I have. So gentlemen, thank you once again. Thank you to all of our attendees, and we look forward to seeing you again at a future workshop. Thank you.
You got it.
Thank you.
Thank you. Bye-bye.